Alrighty, folks, it is 2024. We have the amazing Anna Kelly with us. I thought it would be interesting for us, her and I, to share what we are planning to do in 2024. Because again, there's a lot of noise. I would argue there's a lot of fear. Where there's fear, there's also opportunity. So, Anna, welcome back. Happy New Year. Merry Christmas, all that good stuff.
Yes, yes. Welcome 2024. It's hard to believe we are here.
Absolutely.
It's,
5 or 6 years we've been doing this together, I think. So, pretty wild.
yes, just over 5. So going on
Wow.
6. It's gone by so fast, hasn't it?
It has.
It's
It
been a
has.
lot of fun. Been a lot of fun. Yeah, so 2024 is an interesting year. I think it's going to be a lot like 2023, quite frankly. Unless and until we have a financial event, which still is not off the picture, as far as I'm concerned. Looking less and less like we are going to have, a major financial crisis. I saw that the Fed is going to end the bank rescue program that they put into place,
Mm.
last March, I think it was at this time. So it seems like there might be a little less distress in certain banking markets. I still think there could be some distress, with small regional banks where the commercial real estate just has not yet had to all be rolled off their books. A lot of large office buildings still foreclosing or behind on payments, and so I think you could still have something there fail that could cause a larger economic event, put us into a deeper, a deeper or maybe faster recession, and cause the Fed to really pivot. But barring that, I think that 2024 is going to still be, wait and see how CPI is, see if the Fed's going to lower rates much. But I do expect rates to come down from where they have been. And so, that's always hopeful for us as investors. So I'm looking at, I've been very much in because of where I am in my stage of investing in my stage of life, Michael. I'm not as aggressively buying this last year. And I'm not as aggressive to find really big, large multifamily deals as I was before, because the reality is the market hasn't changed enough. And I think even when the Fed cuts rates, which I would guess would probably be summer unless, something else happens, they'll start cutting rates, but that they're not going to cut them enough yet this year to get us to where pricing is aligned with seller expectations.
Mhm.
And quite frankly, most lenders are really tight right now. So even the holy grail of multifamily lending, Freddie and Fannie loans, you're lucky to get about 65% LTV. And your investors want a lot higher return today than they did before because there's more risk. And so you're having to raise a lot more money from investors. And quite frankly, the deals are just not penciling because sellers aren't desperate enough yet to lower the price that I need to buy that property in order to have a good risk premium for myself and investors. And rates aren't low enough to make those deals really pencil. So I'm looking at deals. I'm one that's going to say you can make money in every market. You have to keep looking at deals. So you can't go, well, it's not a rosy picture. It's not all fun and games. So let's just stop investing. That's not where I am at all. But I've got to find an amazing deal to do a deal because I'm not desperate to do deals. So I'm looking at deals every day. I'm also going smaller with my portfolio. I probably have teased this out in a prior show, but I believe that every market gives us different areas of max opportunity. And when you've been investing long enough, you can kind of move away from that. I only play in one space, one niche, one market, one asset class, because as we build cash flow in our foundation of, providing for our means, we can say, okay, now I'm going to, just like I went from, single family to small multis to mid multis to big multis. Then I did more vacation rentals because I saw more opportunity there. Now I'm going back to looking for smaller, mid-sized multifamily where I can find sellers that are willing to do seller financing, because then I don't have to worry about what's happening in the credit markets. I can just go in and say, listen, you want your price. Most investors aren't going to pay it because they can't make it cash flow. Let's make this a win-win with seller financing. So I'm focusing on smaller deals again for my own family's portfolio, maybe with a couple of partners, where we really focus on cash flow, creative financing, and just add deals to the portfolio slowly as they make sense. So that's where my primary focus is in terms of real estate right now.
That's funny. I kind of see the world the same way. I think 2024 and a lot of assets is going to be kind of a sideways market. Sideways markets can actually hurt a lot of people, that especially the folks that get over leveraged, that are doing this burr game or whatever it is, where they need to keep getting capital out. I think a lot of people are going to get hurt. I'm actually looking really at single families to kind of start the year. I think a lot of single families that are perfect are getting sold, especially below the median. I negotiate on a 4 package deal in late December, right around Christmas. The rough numbers were they wanted 900, I wanted 600. We agreed on 650. I did inspections. I wanted 600. They came back to 625, and I walked away. In fairness, a decade ago, I do the deal at 6 and a quarter. Like
Right.
you, I'm like, I don't have to. It's not a grand slam. Maybe it's just a triple. Um, I didn't want to take on all 4 were occupied. I don't like taking on occupied units because then you have to, wait, especially in California. It could take 3 to 6 months to get them out. And
Right.
it would have been profitable. It just would have been the headache. And the headache to profit ratio wasn't there on
Right,
that
and that's
deal.
that risk premium that we talk about. Everybody's gotta kinda know, like, what return do I need for the risk that I'm taking on? Risk and headache, right? Because
Mhm.
it's not completely passive, and everybody has a different number, and your number and my number are gonna be higher than
Yep.
a newer investor because 'cause we're like, "Is it really worth it?" Our
Yeah.
time. In the beginning, I had no money, so I had to
Mhm.
put in tons of time and sweat equity and deal with all the headaches, like, come with, inheriting tenants that you can't evict if you need to. Now I'm at a place where I'm like, it's not worth my sanity and my
I don't
time.
need that headache. Yeah.
So I probably would do the same thing as you, Michael, just say, here's my number. And we talk about your buy box, we talk about knowing your number. Not negotiating that number. We get so easily sucked in, especially when we have FOMO, like fear of missing out, or we
Mhm.
think there's no deal, so we've got to do this one, even though it's not great. If it's not great now, you'll probably feel it's even not greater later, right?
Yeah,
So,
exactly.
yeah, I think that was probably a wise decision and a good
Yeah,
example for investors who just hear buy, buy, buy. Sometimes the best deals you do are the ones you walk away from.
yeah. And just so you know, they are still listed, so my team is following up on the 14th, so I think that's Monday, I think? I don't know, whenever it is, or Sunday, just to see if he wants to do the number at 600. Follow up,
Yeah.
follow up, follow up, so we'll see what happens.
Absolutely. And I've actually had a couple of deals. I'm glad you said that. I've actually had a couple of deals that I've walked away from that they did come back to me later.
Yeah,
And I got just as good of a deal as I wanted because they had to see that there weren't other buyers in the market
yeah,
for
of
that
course.
particular deal as quick as they wanted and they knew I was there. So those have been actually some of my best deals too, that I've said no and then it's come back and
Yeah.
I've gotten it. So yeah, that's really smart. What about you? What are you kind of looking? I know you said single family. What type of single family deals are you looking for? And are you also interested in, or are you also looking at other things?
Yeah, the big move for me, because I'll still add where it makes sense. There's really 2 things I'm doing. I'll add where it makes sense, but the big thing for me is I really am starting to see what Joseph Wang, the Fed guy, talked about on my channel, the crash up scenario, especially for homes priced below the median. Just for numbers sakes, my median is roughly 400 grand in Fresno. I have a bunch of entry level homes somewhere between say 250 and 300. They don't make those anymore, right?
Right.
Those are going to see, again, if interest rates come in just a little bit, a lot more demand. So something I've been talking about since 2019 might be right around the corner. It might happen this year. It might be 2025. And that's where I repeat what I did in my book, One Rental at a Time, where I sell houses in 1031 into small multis.
Right.
Because like you, I see a lot of opportunity in the kind of 5 to 40 units. That's where my target market is.
Yes.
Um, I expect a 1031 out of houses into small multis sometime between today and summer of 2025. I look
Yeah.
forward to doing that a lot, frankly. That's a big move for us.
Absolutely. And part of that's because the distress this time around so far is in anything that's considered commercial. And
Correct.
really a 5-unit apartment building is considered commercial, where a 4-unit apartment building is considered residential. And the main difference in that is that for most properties and most lenders, and there are some exceptions here with certain DSCR loans, but for most, if you're in a 4-unit or below, you can get 30-year fixed financing. But for most, for 5 units and above, to get really good financing, you're usually only able to lock your rate for 5 years. In the past couple of years, we've seen a few that you can pay a quarter point more and lock for 7, or a quarter or half a point more and lock for 10. But these owners who bought properties in the last couple of years at 3 to 4% interest rates, when they renew, you're looking at 2 years from now, rates are not going to be, I don't think, back where they were. I don't think we're ever going back to zero bound unless we have a major financial crisis that requires it for a while. But I think that that's where, I know, because I'm one of those owners that has these loans that, I've prepared for, and I've gotten liquid, and I'm able to pay down my mortgages a bit if I need to. But my payments, Michael, I've done the analysis on every single deal that I own. If rates go to where the dot plot show in 2 years and in 3 years when I have to refi, my debt coverage payments are going to go up pretty substantially. It's going to cut a lot of income. And so some investors are going to go, I'm going to walk away because they can't afford to take that cut in
Right.
income. I can afford to say, for the assets I want, it's okay. I'll pay a higher debt coverage for a while, but I'll raise rents and I'll just, hold them long term and not be forced to sell. But there are many investors that I know that paid top dollar. They relied on those rates staying low forever. And they're doing the numbers, and they're ticking up on my loans coming due in a year or two at a
Yes.
not due, but the rate is
Reset. Yep.
resetting, and they're not going to be able to sustain that and cash flow. So they're the ones that are going to be motivated to sell at a decent price, and get a really good deal. So that's kind of the why. When people don't understand, well, why go from single to small multis or large multis to small multis? That's kind of the sweet spot where investors usually don't own a whole lot. They don't have a whole lot of experience. They're not willing to hold on. They're not able to, and therefore they're willing to sell, especially if you can work it out with some type of, seller financing deal.
Yeah. And again, on that front, there's also going to be, more and more baby boomers just wanting to be done. More and more kids don't want to be managers. So you're right. I think seller financing. I mean, my dream, right, to put good karma out there is to sell single family homes at, you know, peak prices, like I did last time in 2006, and 1031 into a bunch of seller finance commercial properties. I mean, that would
Yeah.
be, if I could
Yeah.
if I
You
could
and me
ask for
both.
one thing, that would be it.
Yeah, yeah, me too. The other thing about single family homes, and I'm not sure where I land on this. I'm just going to throw it out there,
Sure.
for discussion. But I've heard the ideas, Wang's ideas of a crash up, and I
Yep.
think that there could be some truth to that. But I also think that a lot of sellers are just going to say it's still not easy enough for me to trade up or get out of my house for something else unless they're in distress. The typical death, divorce, job
Mhm.
transfer. Most people are going to do the math and they're going to stay put. And so I think that supply stays constrained, even if
Exactly.
rates come down and there's a demand again. I think that could keep us from having a big crash up. Certainly, certain markets where there's really, um, you know, really strong demand versus that low supply, maybe for some time. But I've also listened to guys like George Gammon recently, and he recently did a couple of videos on, and also some other. I think Stephanie Pomboy might have. There's some others that have kind of floated this idea that over time, over history, one thing about house prices, although you and I have done the math and we went back, 50 years and showed that over time, with ups and downs, the average home still appreciates on average 1% per year on an inflation adjusted basis when you take out inflation.
Correct.
So I do think generally housing goes like this, with some little blips. But they've also shown some interesting data that I don't think we've really looked at, where when you look at wages and you look
Mm.
at the home price per wages,
Mhm.
when we've had any kind of big crashes, they've always kind of reverted to the mean line. So while you've got this, constant trajectory of growth, let's say the 1% per year over time, you've got times when it spikes way high. And then when there's a correction, it comes back to the mean line that is growing, but very, very slowly. And what they're showing is where wages are today, the prices are at an unsustainable level where they think that as we have more pain, whether it's stagflation, wages stagnate and we still have some inflation, or we have a deep recession or a deep financial crisis, that people simply cannot afford homes at today's prices, much less if we have a crash up. And that's going to then lower demand. So when you have low supply and you have lower demand, that could cause some adjustment to the mean. And so it has me thinking, although I haven't seen that happen really much other than, we saw it in 2008 for different reasons, in the 80s after the craziness of the 70s, which we're very much mirroring in some ways. You saw some of this. It makes me wonder, will houses and where will houses revert back to the mean and have a big drop? And I think it's mostly going to be in places, I like to pick on San Francisco, areas like that where the crime is terrible, people are leaving, there's other reasons to leave as well, and the demand is already hurting, and where values just skyrocketed. Places like Seattle, Washington, that's dependent on, appreciation and no cash flow. Like when you wipe out the appreciation too, you're just in a negative. And so I think it's probably more likely to happen in those areas, but I am thinking about that, Michael, and trying to process. I haven't spent enough time putting pen to paper and doing financial analysis on this, but if we do have a crash up, I think it's going to be temporary. And I think that there are some good arguments that single family home values could come down, at least in that mid range and above, because people just cannot afford those payments at higher interest rates than where we were a few years ago and higher prices. And that makes me say, like you, like it might be time to sell some single family homes if they really went up in value and I don't think they're sustainable, and then do exactly what you're talking about, roll into something like multifamily. So what do you think about that?
I think this is a great topic, and you've just stumbled on video number 2. There is a doomer, Crash Bro, that has been talking about home price to income ratios so often. I've even seen him quoted by George Gammon and others. So I took our 53-year spreadsheet, which and I built our own charts. We will bring that up in video number 2. Anna,
Awesome.
before we do that, where can they find you?
Great. You can find me here almost every week on your show. You can find me on social media at Anna Kelly, REI Mom. And if you're interested in coaching or consulting, help with deal review of small to large deals, you can find me at AnnaKellyInvesting.com.
Thank you so much. Video number
Thank you.
2, price to income, the great chart. Thank you, Anna.